Now, before we begin, before we jump into those email questions, we also want to jump in and review our recently posted content, mostly from last week. We had 6 videos posted this week. There was a topic on just getting started with options investing, where to start, what kind of education to go through. We had a question related to direct search criteria settings, how to remove a specific underlying that had a recent gap up or recent gap down using the search tools in Power Options. Covered a great conversation on criteria for the optimum time frame to roll a covered call, and we focused on the portfolio tools there to set the alerts to help us with that. Tools for evaluating long options, buying calls or buying puts. We did a quick, 9-minute review, 9.5-minute review there of the tools available in Power Options that a long call investor, long put investor would look for. And that was related to a question that came in on when to expect a profit on a bought call or bought put. And today we actually were able to finish up the extra 12 minutes of presentation we wanted to carry over from last Friday's discussion from Edison on when to exit a married put position during a market downturn, or do you even have to exit it, because you can use some of those income methods that are talked about in the blueprint to help readjust the position and be able to take advantage if you think the stock's going to recover or potentially continue down as well. So that's some of our recently posted content from last week. We have these playlists up here. I'll be referencing some of those. And for Mike's question that's coming up in just a moment, we'll be referencing that. And for, this question that just came in was from Michael J. We'll be referencing this too as well, in addition to covering the content. Well, all of that being said, let's go ahead and navigate over to the Power Options suite of tools. And we'll take our first question from Mike E. that came in via email. And then we'll get to Chuck's question, and then we'll get to Mike J's question, which just came in at the beginning of the presentation. Would help if I change the screen, of course. And there we go. All right, so here we are at the Power Options tools. And Mike sent me a question via email a little while ago. And Mike, if you're online, I did not see your screenshot that you mentioned in the email that you sent. But Mike E's question was, I have attached a snapshot of a Bull Call Debit Spread screen from today. Is it correct that all of them are showing a percent return of 42.9%? Can you please explain how to best use this screen, the default search initial values for trading? All right. Bull call debits. Parity trade to a bull put credit spread. And what we're going to do with our bull call debit spread is we're going to buy an in the money, typically, call. Whether it's deep in the money, whether it's just a couple strikes in the money, we'll get to that in a moment. And at the same time, we're going to sell an at or just out of the money call, or maybe even a slightly in the money call. We're going to pay a debit to enter this transaction between our two calls. And let's say that we had a 5-point spread and we paid a debit of $4. Now, what happens at expiration if the stock is trading above both strike prices, which is what we want for maximum profit? We'll exercise the long option to buy shares of stock at this price to cover our obligation at this price. And if it's a 5-point spread, we'll get $5 back, the difference in the strike prices. So effectively what happens there is we make a $1 profit off of a $4 investment for a 25% return. That's it, basics in a nutshell. But let's go ahead and take a look at the search and take a look at some examples here. We're going to go right into the search tool for Bull Call Debits. And anytime I click on a search tool, it's going to pull up a list of potential trades. These match the default criteria that we have that you can use as a stepping stone to create your own personal search, or of course get various trade ideas and further research and analyze the positions that appear. This is the weekly Bull Call Debit, where we're looking to go slightly in the money, looking for a good probability above 70%, the theoretical probability that the stock will remain above both strike prices, just like a bull put credit spread, so where we would receive the maximum return. For a shorter term trade, 1 week, 2 weeks out, it is better to go slightly in the money to have that better probability of assignment. If you're more bullish on the market, we're going to talk about what's called an at or out of the money bull call debit spread in a few moments, but I'd want to go further out in time in that case to allow the stock more time to move in my desired direction. But let's take a look here at Mike E's search he was viewing, the default initial values. This is a similar search, but it's going out to standard expiration, 20 to 30 days out in time. This search is still looking slightly in the money in this case. You see here we've got AMC at 2024, and it's showing a 13.5 call at 660 and an April 13 call at 765. Now showing me a midpoint net debit of 25 cents. That might be hard to get to, but we're going to talk about that in a moment too. Now, I didn't see, again, as I mentioned, Mike's screenshot, but here we see some down at the bottom. FCX, Freeport McMoran, trading at 51.93, and we could sell the 45.50 upper strike call, which is still in the money, and buy the 45. We might have a net debit of around 35 cents at midpoint, and that would give us that 42.9% return. Now, I'm not showing the bid and ask here for both options. We're just showing the long option ask and the short option bid, but the midpoint prices would give us those values. They might also be very wide, which is something I'm going to address in a moment. What is this default search looking for? It is looking for bull call debit spreads that are out to April expiration. It's looking for a minimum 10% return and going at least 3% in the money. That'll also help dictate the 70% probability that the stock will remain above both strike prices. And in that case, we'd receive the full maximum profit if we held it all the way to expiration. Other criteria that we're using in the stock technicals, we're just looking for stocks trading above the 50-day moving average. And we're just looking at some basics for the stock price trading above $9. And of course, with any slightly in the money, or when we say in the money debit spread or out of the money credit spread, where we're looking for the higher probability, we want to avoid earnings between now and expiration. We don't want any sudden surprises where an in the money high probability spread, in this case with the debit spread, the stock has too sudden of a move. We are taking, in most cases, a 4-to-1, 5-to-1 risk reward ratio with the in the money structures. So we don't want anything that's way beyond our control suddenly happens against our expectations, and we end up taking full loss on the trade. Now, as I mentioned, the default search here, Mike, is just basic criteria to help you get started. You can adjust the criteria any way that you want to meet your needs. If you wanted to go further in the money with your bull call debit spread to have a better probability, you could just make that change in the percent in the money field or in the probability. I'm going to go 80% or higher in this case, and I'll just go ahead and submit the search. I may want to look for a more strict simple moving average since we are only 20 days out in time. Usually if I'm 25, 40, 50 days out in time, 25, 30, 40 days out in time on a search, I'll use the stock price to be above the SMA 50. But if I'm under 21 days, I'll typically want to change that to look for stocks under the SMA 20. I could also reduce it further and look for stocks where the SMA 20 is above the SMA 50. Also, I might want to add in a MACD cross just to see stocks that have had their MACD line cross over the signal line by at least 2 days or more. So seeing more of a pronounced uptrend, similar to what I would look for in a bull put credit spread. Okay, so now we've taken some of those results out on the positions. Now, some of these are extremely high. This DocuSign one I saw earlier when I was preparing for Mike's conversation, the bid-ask spread is not that wide. But these positions are highly inflated due to some event coming up that may or may not be related to the earnings, which it shouldn't be because we're avoiding earnings between now and expiration. But just general high implied volatility, $14 here, it's deep in the money. We're about $12.50. No, even $13 roughly in the money. We've got $1.15 of time value for that deep in the money position. And the long option, 50 cents away, is that not far apart? Now, one thing I will suggest, it's my personal sentiment. It is not, I have no proof that it's any better profit and loss wise. All the testing I did with the bull puts showed me that it was better doing it this way. I don't know if it actually applies to the bull call debits as well, but typically we found that doing the 1-point spreads and the 50-point spreads was not as effective as using spreads that were greater than or equal to 2 points. So the same thing I use for the bull puts, I'm going to put in here for my Bull Call Debit Spreads. That's just a personal trait. You can make that adjustment as well. You still got some really good positions here, but notice we filtered out some of those odd 50 cents and $1.50 spreads as well in those cases. All right. But this is what we're looking at here. Again, Mike, I didn't see where all of the screenshots you had were 42.9%. I think that was just a random occurrence in the market. It's not always like that, as you can see here, after making just a few basic tweaks. Let's take a look at the profit and loss chart and discuss what we're going for here in these positions. In this case, we're opening a slightly in the money Bull Call Debit Spread with a good probability of the stock staying above both strike prices. In this case, we want that. We want the short call to be assigned. We wouldn't mind if it was assigned early because we own the lower strike call, which our broker would probably exercise for us in the case of early assignment, and we'd get out for the full profit on the position early. This is a 2-point spread where we're paying $1.45 net debit between the midpoint prices. The maximum risk is $1.45. If the stock falls below our bought call strike of $1.41, both calls will expire worthless. We'll lose the $1.45 debit. If the stock stays above $1.43, the sold call strike price, we're in the money where we want to be. We'd exercise the long to deliver the short at expiration. Technically, our brokers would. We'd get $2 back, so we'd get a return of $55 total off of a debit of $1.45. That gives us that 37.9% return on the position. Now, we want a neutral to bullish stock. That's why we walk through some of those technicals and fundamentals we just did. We want to avoid earnings between now and expirations. Just like any bullish strategy, Mike, whether you're doing a covered call, bull put credit spread, call buying, you'd want to put criteria into the search that match what you would look for a neutral to bullish stock. Here we're looking for that stronger probability above 80, 82, 83%, giving us that better probability that the stock will remain above both strike prices and we will receive that return. This is one way to approach it. This is one way to do the Bull Call Debit Spread. We saw the weekly default search, same idea. It's starting out looking for bullish stocks, shorter term, good probability above, with those other criteria and avoiding earnings between now and expiration. The initial values is a monthly Bull Call Debit Spread screen. If you didn't want to do monthlies and you didn't want to do weeklies, you wanted to do shorter term, you could easily set this up to just say, hey, show me all expirations, but positions that are greater than 7 days out in time, but no more than 20. Okay? So you'd be looking at the 2-week out positions or the 10-day out positions in those cases, and you're still seeing some reasonable returns. Naturally, when you go farther out, you see a higher return due to the better time value. What you're not seeing is a higher annualized return. You always see that with the weekly options or the 2-week out options compared to 30 days or 60 days. So these are the in-the-money ones with the higher probability. Now, a separate approach, if we're more bullish on the market, or if we're more bearish on the market, say for the next 30 to 40 days, you might do a bear put debit spread this way. But if we're bullish on the market for the next 30, 40, or 50 days, another approach is to use what's called an at or just out of the money Bull Call Debit Spread. And we've got a default search here, a theme search set up for that in the sample searches. So we go into sample searches here and we have OTM, out in time Bull Call Debit Spreads, out of the money Bull Call Debit Spreads, 60 days out or more. And what would those structures look like? Well, they look similar, but in this case here, you know, we've got this first stock here is, let's take Apple. Apple's at 174.72. That's a little bit farther out than I want to go, but it's 175 days out. I'm sorry, 147 days out. We could sell the August 175 call and buy the August 170, a 5-point spread for a net debit of only $2.98. Naturally, with an at or just out of the money spread, this is only a 50-50 probability or less than 50% that the stock will be trading above the short call strike price and you'll make the maximum profit. Why would we do this? Well, let's take a look. Let's go to the profit and loss chart. The concept of the farther out debit spread, and again, I mentioned this one might be a little bit too far. I'd probably want to go 60 to 75 days out in this case, but that also depends on your market sentiment and your feeling of where you think the market's going to be in 30, 40, or 50 days. In any case, the at to out of the money bull call debit spread is closer to a 1-to-1 or 2-to-1 risk reward ratio. A lot of times, if we straddled the position with Apple right at 174.72, let's call it 175. If I sold a 180 call and bought a 170, a 10-point spread, I might only pay $5 for that debit. Now I've got a 1-to-1 risk reward ratio. Why is that important? Well, the deeper in the money debit spreads, the more conservative ones we just looked at, and the deeper out of the money bull put credit spreads have that higher probability. But what we saw is that with that higher probability, and the one spread we looked at was a debit of 145 for the max return of 55 cents. It's close to a 3-to-1 risk reward ratio. As you know, Mike, the bull put credit spreads that I typically look for have an 85% probability or higher deeper out of the money positions for 10 to 14 days out in time. Those are usually at a 7-to-1 risk reward ratio, or might be making 25 or 30 cents on a 2-point spread. So, risking 175 here for 25 cents, maximum profit. So we're looking at closer to that 7-to-1, maybe 8-to-1 risk reward ratio. You would never do this at the money or out of the money approach with a bull put credit spread, even though these two are parity trades, but you'd never do that with a bull put credit spread because you're starting off with a short put in the money or just at the money. And remember, in the bull put credit spread, the sold put gives me the obligation to buy shares of stock if the stock is trading below that price. And this lower strike put, the benefit of having that to curb the losses, it gives me the right to buy, to force someone to buy my shares of stock, at the lower strike put. That doesn't kick in unless it's below both strike prices. If the stock's trading here and I get assigned early, I've got to pony up all the dough or have it on hold in my account to fulfill the obligation of the short put. In a bull call debit spread, you don't have to worry about that. Yes, you still sold a call, which gives you the obligation to deliver shares of stock at this price that you don't own. However, you own the right to buy shares of stock at this lower price. Even if you're assigned early, your broker will exercise this long to deliver the short. You won't have to worry about being short stock in this case with a short call obligation. This is an approach that's used, but again, you don't do the at or just out of the money bull call debit spread shorter term, 7, 14, maybe even 20 days out in time. This at the money, out of the money bull call debit spread, looking for closer to a 1-to-1 or 2-to-1 ratio, is best used going 30, 45, 60, maybe as far as 75 or 90 days out in time. So, Mike, that's sort of the answer there for the bull call debit spreads. Any search you see or sample search is designed to give you a starting point to find positions that match your goals for that strategy in your account and the criteria that you'd use to identify an underlying security that matches the sentiment for the position. For bull call debit spreads, we're looking for neutral to bullish positions in those cases. And so we'd put the criteria in that would relate to that as well. All right, so Mike, I hope that covers the questions there. It's the same approach for any strategy. If I went into covered calls, for example, the default search is here. There's an in-the-money covered call search default and out-of-the-money covered call default search, weekly default search. They're designed to be used as a stepping stone to help you identify positions that best match your needs. You can adjust the criteria in any strategy as you want to find just the positions that match your targets, your goals, and your risk reward threshold. There we go. I'm sorry. I just wanted to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or suggestions, other than the idea of maybe avoiding a trade such as a credit spread, debit spread, directional trade, iron butterfly on MU or a stock that has earnings coming up between now and expiration. Options involve risk and may not be suitable for all investors. Now, today we had a chance to go through the search discussion on the bull call debit spreads. We looked at the profit and loss chart a little bit to analyze those calendar spreads. We also took a look at some of the butterfly screens and filters. Didn't get to the portfolio today, but did talk about the market sentiment tool and others. Anyway, if you like the tools you saw today, you can take a free 14-day free trial at any time. No credit card required, just first name, last name, and email address. You'll have full use of all of the tools for 14 days. After that 14 days, the subscription services start at only $45 per month. That's for the end-of-day data service. We only see data updated at the end of the day. The delayed service is only $65 per month. Data is delayed about 12 to 15 minutes. And of course, we do offer real-time service and other add-on features as well above the delayed service. We reviewed the free education a couple of times. Remember, you can go to the free webinars page on Power Options at any time and go through the different archive presentations, or you can go to our YouTube channel. Just look for Power Options on YouTube and simply just type in a topic: poor man's covered call, diagonal spread, debit spread, credit spread, and you'll get a list of all of our presentations. You can scroll through and find out which titles best match your goals. Of course, a good place to start is on the playlists. And for Mike E, I thought I had one there. I thought I'd finished it this week. I didn't, but I'll get a Bull Call Debit Spread one up there as well, which will have 8 to 10 videos related to structure, criteria, setup, management, and more, just like all the other playlists that we have. Now, if you do think of any other questions at any time later on, remember you can send me an email at any time over the weekend to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Of course, trial members to Power Options and subscribers can schedule a coaching session. That's essentially a 45-minute conversation on the phone with myself or Ernie. We'll answer any questions that you have and take you through the site. So trial members and subscribers, you can schedule a coaching session during the trading day at any time as well.